Financials might not be the sexiest sector of all time, but I think it's got pretty good prospects going into 2025. Continuing on with our theme of breaking down individual S&P 500 sectors and kind of our outlook for the next year. It's going to be really interesting to see, I think, this sector in particular, all of the dynamics going on, because I think it really does have a fairly bullish setup going into next year. And we'll get into some of the kind of subsectors of the financials market that we look favorably upon. But it's really been interesting to see the development over the last few years. I mean, you had 2022, Fed starts hiking rates. It's pretty bad for financials. Banks are freaking out because you've issued all of this debt at low interest rates, and then all of a sudden interest rates have just spiked. So now you're paying substantially more on deposits and CDs, whereas you've lent all this out in the very low percentage range. So starting off in 2022, kind of a precarious situation, leading into 2023 in that banking crisis. But we've had some kind of interesting developments from there.
Yeah. So like you said, 2023 was tough on the financials. A lot of concerns about the stability of the banking industry. A lot, actually kind of escaped that one unscathed, more or less. We had a couple banks have to get bought out and stuff. But, I think that really speaks a bit to the resilience of the banking industry as it stands, is even despite this huge shock, there was minimal fallout. I think there are a lot of lessons to be learned there. But then going forward into 2024, it's one of the best performing sectors so far this year, second only to communications. So obviously there's something there. Everyone really looking forward to a couple changes coming down the pipeline, namely rate cuts and a more amenable M&A type of environment, which includes reduction in regulation. But Victor, why don't you run us through what we're expecting for 2025?
Yeah, you're right on with that. I think the combination of deregulation of just broader corporate America in general, but then especially in the financial sector, is going to be very beneficial for a combination of banks, financial institutions, any kind of deal making, and then the rate cuts, as you mentioned. So kind of getting into those, I think first and foremost, the deregulation piece. We've seen very serious intervention from the FTC, the Free Trade Commission, and the DOJ, Department of Justice, into mergers and acquisitions that have been proposed over the last few years. I mean, 2023 saw a record number of interventions. They had 50 interventions and mergers on that year. And so I think starting first and foremost with that deregulation aspect, it's going to be very bullish and beneficial for any companies that are looking at supporting or conducting merger and acquisition activity, because a lot of financials companies, investment banks, a lot of your kind of consulting or private equity firms, they deal with a lot of that. And so facilitating an environment that's better for mergers and acquisitions and just general deal making is going to be very beneficial for those financials companies.
Yeah. And talking about M&A, the FTC and the DOJ really, the combination, but maybe picking on the FTC a little bit more here, blocked a number of transactions that people really expected to go through this past year. You look at that Spirit and Frontier merger. Well, they blocked that despite both companies kind of struggling, Spirit especially struggling and needing that scale to really compete with the traditional carriers who, mind you, have really gotten down into that, cheap bare bones fare structure. Like if you want to go that route, then you can do that through American, through Southwest sometimes, through some of these other carriers that's really stepped into that Spirit Frontier space. But the FTC stepped in to block that. And only about a month later, you had Spirit filing for bankruptcy. So that's really tough on those companies. You had another one in the airlines recently with that Tapestry and Capri merger that we talked about, or acquisition, that on a previous podcast, we talked about it, that got blocked. And this is two luxury handbag or luxury goods companies. That's Coach and some other ones,
Michael Kors.
Kors, thank you. Don't know those as well as I probably should. But, Coach and Michael Kors are, they're fairly luxury goods. And generally we don't see these government institutions stepping in to, protect the millionaire consumer or the upper middle class consumer and, for luxuries. But here we are. So that kind of just goes to show the current environment we're in. And I think businesses are really optimistic going into 2025 and really just going forward that some of this will change, that some of these, agreements can like make it past the start line.
Right. I think I saw some pretty insane stat recently that the FTC and DOJ combined have some kind of lawsuit or some kind of regulatory scrutiny over 50% of the S&P 500's market cap. Granted, that's not 250 of the S&P 500 companies, but basically all of your big companies, all of your big tech companies, they have some kind of antitrust or some kind of regulatory scrutiny over them right now that they're doing some kind of investigation. And we expect under the new administration for that to really shift substantially. You're going to be looking at new leadership at the FTC, new leadership at the DOJ, and then the SEC as well. And so as far as these regulatory bodies, I think it's going to be really interesting to see the shift and how that can benefit the financials companies, because a lot of these, like I mentioned, are doing that deal making. The investment banks have seen deal making dry up really considerably. If you're talking about M&A, and then IPOs, initial public offerings as well, have really cooled off recently because companies are just not sure about what the regulatory environment is going to look like. And so they just haven't been eager to make these changes, especially when they've seen these examples that you just mentioned, where it's extremely expensive to enter into a merger or start a merger and then have to have that completely unwound.
Yeah, there are lots of dollars in, legal fees, financial costs, and just implicit costs that go along with even proposing a merger acquisition. Just to have those shot down immediately is tough on these companies. Kind of taking us to the next step, walking into rate cuts. We've already seen the first slew of rate cuts this year. We're expecting about another % next year. And so this is going to help the economy and help individual companies in a number of ways. You traditionally have that inverse relationship between the Fed funds rates and that deal making we've been talking about, because as rates come down, you can afford to do your leverage buyouts. You can afford to take on additional leverage just to fund the purchase of another company. And so there's a lot more, money in the economy. Because that's why, the Fed raises interest rates in the first place, is to take money out of the economy. So as they cut rates, that money flows back in. It can turn over and turn into those acquisitions, which also helps broad companies, like the broad market in general, even if you're not, taking part in M&A deals. But, we generally see that, accretive to equity prices. And along with that, is you have asset management companies who it's kind of like almost a self-fulfilling investment in a case. It's interesting to think about it that way, where asset management companies who own the rest of the market, are going up in value because their underlying investments are going up in value. And as their AUM increases, their billings going forward will also increase. So that's a kind of an interesting one to think about there too.
Yeah, I think it's interesting whenever you're really breaking down the financial sector into those sub industries, because to your previous point about rate cuts and then the companies that are going to benefit from that, well, who needs functioning capital markets the most? It's those small and mid-sized companies that are continuing to grow, that need access to equity capital, that need access to debt capital. And when you have the combination of that being able to finance that at lower rates, but also a better regulatory environment, well, those small and mid-sized companies really benefit. But then when we're talking about the financials companies specifically, it's those that are facilitating that deal making, the investment banks, the private equity firms, those are going to benefit. And then to your point, so when we're talking about areas of financials that we like, I think the banks with heavy investment banking activity, private equity firms that are going to see an increase in deal making, because we've seen deal making and M&A, even on the private side. We were mentioning public earlier, but on the private side as well, really dry up over the last couple of years. That is a combination of higher interest rates and higher regulation. But we also like those asset management firms because, yes, we've seen the market perform extremely well in 2023, 2024, and we are looking forward to what should be a pretty modestly positive market in 2025. So all of those, or the majority of those companies, have seen AUM, assets under management, increases over the last few years, whether that's a combination of new money or market growth. I mean, we can say that we've experienced exactly the same. So we feel positive about the outlooks for companies with big asset management firms as well.
So you mentioned those small and medium-sized banks benefiting from rate cuts. And something that's going to benefit all banks that are loan making is that net interest income, their net interest margin is going to improve as the short-term rates come down and longer-term rates still stay elevated. They'll likely come down a little bit as well, but you'll get that normal yield curve because we've been in an inverted yield curve for a very long time. We're kind of back and forth on normalization, depending on which years you take there. But as the yield curve becomes normal again, you get that positive net interest spread. And then that'll be very beneficial for all banks because that's traditionally how a lot of banks make their money is they borrow at short term, they take on deposits where they pay very little and then loan it out 30-year mortgages, small business loans for 5-10 years. So they're really taking that spread in interest rates, but there hasn't been that spread for the last few years.
Right. That's why we've seen them lean into more asset management, other services, because your traditional banking and lending just hasn't really been that profitable part of the business. And I think it's important to bring it back to the deregulation point too, because what banks have had hanging over their head are the Basel III requirements. And these are reserve requirements after how much you have to hold, what you can lend out essentially. And these really came out of the global financial crisis in 2008 because we saw that banks were a little bit over levered. And then all of a sudden in a period of extreme stress, you had a significant meltdown. And luckily, you had some companies and the federal government step in to really, solve up the banking situation. But these Basel III requirements have been really speculative. They've changed a lot, and they have a lot of serious implication for how banks are going to be able to conduct their business. Well, the thought process now is that these are going to be formalized in 2025, and they'll be a little bit more favorable than what was previously anticipated. So banks can get back to a period of lending out what they normally would be under the guise of the guidelines and such, because they haven't really been lending out to full capacity over the last few years, just because they haven't known what the regulatory environment is going to look like. So that's going to be a really big benefit when it comes to your traditional lending and traditional bank activity over the next year or so that we just haven't seen in the last few years.
Yeah, exactly. The initial draft of this latest revision, which they call it Basel III Endgame. So maybe it's the end for right now, but even if it's not, the initial draft of it was very burdensome. And so it's caused especially the big banks to really just hoard cash, not really being able to lend it out at long-term rates, because then they get locked up into something and then they don't have the capital requirements if this, comes to fruition. So that really hampered them for a while. And so now they're kind of seeing a light at the end of the tunnel there. These things really not turning into anything too burdensome, which has been, I do have to point out, a great process in that they drafted these regulations, and then they had a lot of dialogue with those big banks and got to kind of understand that this is not going to work. People are going to suffer because the money is not going to flow in the same way it has been. And so really just dialing these back has been a really good process to see that, these, multi-government solutions can actually have some discourse and come to what seems like, from kind of an outsider's perspective, a good compromise from both sides. Because everybody wants banking stability, but also you want banks to be able to make those loans, because I would like to buy a house maybe. And, if I can't get a mortgage, or it's an absurdly high price because banks just can't afford to make that loan, then it creates, more issues by itself. And then kind of in closing, I want to take a look at what are the risks to all of this, because there has been, like we've covered a lot of positives for the financials industry. They've done really well. And along with that is all of these have appreciated pretty high. So, if you've had that kind of multiple expansion, and so if that comes in for any reason, then, that could be detrimental to companies. And then one other thing I want to point out is the rate cuts. There have been a lot of concerns as kind of a moving target about what rate cuts we'll get next year. The market was pricing in about 6 originally, and now has dialed that back to closer to 4. I think we're still a little bit over 4 rate cuts for next year that the market's pricing in, but they've already brought that in. So we'll see what this next Fed meeting and next dot plot looks like, but that's a big risk to this forecast here.
Definitely. And I think you hit those just right on the head, is that your two risks really are that the points where we've been bullish just aren't delivered to a full extent. So if your deregulation agenda by the new administration just doesn't come to fruition, of course, there is a lot of contention still going to be within Congress. I mean, the House is very, very narrow majority there. And so if you aren't able to pass some of this deregulation legislation, or just move forward with some of these things like Department of Government Efficiency and things like that, that maybe won't deliver for these financial companies the way that we expect, that could be detrimental. To your point, they've seen quite the run up in anticipation to some of this deregulation. So if all of a sudden that has to be unwound, you could see a reset in valuations. And then to a similar perspective, rate cuts, if the Fed doesn't deliver on these rate cuts, say inflation stays more sticky, we get maybe 2 rate cuts next year instead of 4, it could be a more difficult situation for financials, which should be interesting. The only other thing that I would kind of add is it's always a risk to financials and frankly the broader economy, but some kind of exogenous shock. Geopolitics are kind of falling into this. There's a lot of conversation of, well, the dollar reigns supreme, which of course financial institutions rely on a strong dollar, and the US being the predominant currency worldwide. Well, if you had greater conflict with China, or them kind of trying to influence our currency or financial markets to some extent, that could be a risk. But of course, black swan events, you can talk about them, you can't predict them necessarily. So it's just something worth mentioning when you're talking about the broader kind of risk calculation going into investing in these companies.
Yeah, exactly. Some really good points there, Victor. Well, thanks for a great podcast. And I'm really excited to continue this series that we've been doing, kind of taking a deeper dive into some of these sectors. And I think financials is a really interesting one.
Absolutely. Thanks, Hunter.
Thanks.